Welcome to this webinar hosted by Richard and James, co-founders of MyFinanceFuture. This is the third in a series of webinars about how to use the MyFinanceFuture Planner to help you build your own financial plan and enable you to take control of your financial future. Today's topic is how to optimize your financial plan. It's a broad and potentially complex subject and is mainly intended for those who've already created a first version of a financial plan. If you're new to financial planning, we'd encourage you to first watch the previous videos in the series, but hopefully this session will signpost to you the many different ways to optimize your plan and improve your lifetime finances by potentially tens or even hundreds of thousands of pounds. So let's get started. I'll be monitoring the chat for any questions, but here's Richard to lead us through the topic.
Hi there, thanks James. Hopefully everybody can see my screen. We've got a packed session, so I'm going to move straight into the agenda. So during the session, we're going to do several things. First is we're going to explore what we mean by optimizing your plan in practice, which is important because I think you can have quite a lot of preconceptions about this that we want to dispel. Why should you optimize your plan? It's a useful exercise which has huge value, can take some time. You need to develop some understanding. So why spend that time? I'll talk through where optimization sits in the financial planning process, referencing back to our previous videos, which James mentioned, and I'd also encourage you to watch those if you haven't. What steps you should take to go through the optimization process in a structured way and sort of navigate the process so you achieve an outcome over time. What are the potential changes you could make to improve your plan? So a laundry list of ideas and techniques, which I'll share with you. And then we'll go through a demo using the MyFinanceFuture Planner of how to apply some of those techniques to a case study to give you a feel for the process and how to go through it and how to use some of the techniques using the MyFinanceFuture Planner. And finally, we'll move on to Q&A. So as James says, put your questions in the chat and we'll try and consolidate the key ones at the end of the session and answer as many as we can. So what does it mean to optimize your plan? Well, the first thing is to make your plan work better for you. What it doesn't mean, I should say, is creating the plan from scratch and making it work for you overall. So working out when you can retire, have you essentially got enough funds so you will be able to retire when you plan to. Once you've got to that place, you really need to get to that place first and get the big moving parts working. Then you can start to optimize and make your plan work better for you. As the biggest part of this is to make your plan more tax efficient. So how you can navigate the tax system to avoid paying too much tax at different stages of retirement. And there are several stages here which can make a big difference. There's the pre-retirement period, there's the transition into retirement, there's the 2 or 3 phases that many people experience during retirement, and then you have the legacy period and inheritance tax and all those sorts of things. So how can you make your plan more tax efficient? As part of that, you'll work out how to use different types of investment, in particular ISAs and pensions, but others also to try and work out how to fund your spending in retirement in an efficient way, how to contribute to your investments in an efficient way, and how to have a tax efficient withdrawal strategy. As part of that is a balance between flexibility and tax efficiency. The 2 best examples are pensions, which are the most tax efficient vehicle commonly available, where you get the most tax relief and the benefit of tax-free cash, which generally makes them a very tax efficient vehicle, but they do have some issues with flexibility. So you can't access the money until later in life. It's locked away for some time. And towards the end of life, with the introduction of inheritance tax on pensions, they're no longer an efficient vehicle for passing money on to the next generation, and they're constrained in terms of their ability to withdraw money as part of a gifting strategy, because you have to pay income tax on the withdrawals before you're able to gift. So there's some flexibility constraints around pensions as well as being tax efficient. So there's a balance to be drawn. And finally, balancing risk and returns. So this is really around making sure you've got the right balance. So a lot of people we know from the news hold much of their assets in cash at retirement. That may not be the best answer for them in the long term. If they've got a long retirement period, then it may make sense to rebalance into higher return investments for at least part of their portfolio to achieve a better outcome overall. Obviously, there's a risk question, how much risk each individual is willing to accept and all the rest of it. But that is certainly part of the optimization process, choosing the right balance for you. Before we go any further, a quick disclaimer, because we are in an area which is covered by financial advisors, to make the point that we aren't financial advisors, and this isn't financial advice. The planner, the MyFinanceFuture Planner, provides tools to help you optimize your plan, but it doesn't automatically do it for you. It's a process you go through yourself, using the tools to create a plan that you're happy with and works optimally for you and your situation. It doesn't calculate it itself, so you have to be self-reliant on this using the tools available. We provide ideas and suggestions, but the decisions in the end are yours and to take through and execute your plan. Things will change, so the decisions you make now may not be optimal for you looking backwards with hindsight in 30 years' time. So you have to take those factors into account, and there are no guarantees about what changes will happen in the future. That said, planning is a very valuable tool, and you can make a big difference to your outcome. So there's a balance to be drawn around it. Having said that, I want to emphasize why it's worth spending time optimizing your plan. Well, the first thing, as James mentioned in the introduction, is that it could make tens or even hundreds of thousands of pounds difference to your lifetime financial outcomes. And hopefully you'll see from the example that where those types of benefits could come from. So it's a worthwhile thing to do financially. Going through the process can help build confidence that your financial plan is the right one for you and you're happy with how it's taking you forward. Obviously, the caveat around things can change. You'll need to maintain the plan to keep it optimized for a developing tax environment and all the rest of it. But it's important. I think there's value in having confidence that your financial plan is the right one for you and you feeling that. Better understanding of how to execute your plan. So having gone through the planning process, you'll have a better understanding of the moving parts and a better understanding of what needs to be done to execute the plan. And finally, going through that process, you'll build peace of mind that you've properly thought things through and are in a good position to move forward. So what doesn't it mean? Just to dispel a few myths. And I sort of can't emphasize enough that it doesn't mean making a perfect plan. There's definitely a law of diminishing returns around this. You'll get a lot of the benefit out of making the big decisions and getting to a sort of 80 to 90% answer. And after a while, refining it further stops having value, especially considering things do change and you're better off spending the time adjusting it as big things change in the future, rather than refining it only to find in a few months' time the refinements weren't really worthwhile because bigger things have changed through the next budget, for example. So you don't expect to have a plan that's right all the time. Make the big decisions, recognize when something's changed that means you should reconsider them, accept some small changes, maybe market movements which aren't significant. You just roll with those and accept that your plan won't be 100% perfect all the time. And the final thing is, don't keep trying to make the plan perfect at the expense of not actually acting on it, because that's where the real value happens. You can plan all you like, but if you don't act on the decisions you make, then it won't really help you in real life. And there's a couple of quotes I wanted to, you've probably heard these before, but it's worth reflecting on these in terms of moving to action. So the planning process is the most important thing. The plan that comes out at the end is useful as a reference point, but not that important. It's having gone through the thought process and having made your decisions that's the key thing, and move on to execution rather than trying to spend all your time perfecting your plan. Okay, so just to reflect on the overall planning process and where optimization sits within that, if for those of you who've seen our other videos, you'll recognize this chart. The first of the 3 videos in the series focuses on the first 3 steps in this process, establishing the financial foundations, creating a big picture plan, then tailoring your plan to achieve your goals, basically. And then the step we're on now is to test and optimize your plan. The last video covered the testing part, and we're going to cover today the optimization part. The 2 things work together to create your final plan. So looking at the test and optimize stage in a bit more detail, we covered, as I said, the test stage last time and the effects and how you adjust your plan, or you accept how the adverse events could affect your plan through a testing process, looking at things like market crashes, employment changes like redundancy, health effects, or early or later than expected life expectancy, and how your plan deals with all those things. We're now moving on to optimize, and essentially this is around the balance between your investments, how you contribute and withdraw to them, and withdraw from them, and the tax implications of that, and trying to navigate the most efficient route through that, minimizing the amount of tax you pay overall across your lifetime. So how do you optimize your plan? Well, we wanted to come up with a process you could go through in a structured way to optimize your plan. And we would advocate this, and I'll follow this as we go through the demo. First off, review your goals and assumptions. So understand what you've been trying to do with your plan when you first started the process of planning overall, and what assumptions you were making, in particular, as you went into the testing process. And have those as reference points in your mind as you go through the optimization. The first stage of that is to find leaks and opportunities. So review the output of your plan, see where there might be efficiencies to be gained. Maybe there's high peaks of tax during the period of the plan, which might be targets to try and reduce those. Maybe there are particular features of the plan, and one we'll focus on today is around an imbalance in investments between the two partners in a couple, which you have in the back of your mind as you go through the optimization process and identify ways to improve the plan. Second step is looking at the various optimization techniques available and choosing the ones that are most likely to improve your plan based on the leaks and opportunities you identified. And finally, in an iterative process, run trials of those optimization techniques against your plan and assess the results and improve the plan, and add more optimization techniques as you go through to see what works best in conjunction with each other to achieve a better result for the plan as a whole. And once you're happy with it, update your base plan and move forward. So the first step is finding leaks and opportunities, and I just wanted to give you a high-level view of the types of things you're looking for. And we'll send out a list of these and the various techniques for optimization as a follow-up document post this call. So don't worry too much about having all of these. I won't have time to go through them all today, because we don't have time to go through them in depth, but it should nonetheless act as a useful aid memoir. The sort of things you're looking for are tax inefficiencies where you're paying tax in the higher bands, maybe during part of the plan, either during your working life or in retirement, where you're receiving incomes in the higher earner's name that don't need to be received in the higher earner's name, where you're paying capital gains or inheritance tax, which can potentially be mitigated, or if you're paying some of the higher tax charges, then those can also be avoided if you plan correctly. And then looking at the other aspects, high interest debt, unplanned spending, and other costs around investment and so forth, and in particular higher than necessary spending in retirement, because there are opportunities to be more efficient in retirement if you think those through. and the investment balance, and whether you've got the right mix between cash and other investments to give you the right level of return for your risk appetite. What techniques can you apply to address those leaks? Well, there's a long list, but I'll put them into these categories to give you a sort of top-down view. Spending and debt, investment contributions, investment withdrawals, reinvestments, IHT, and risk and return on assets. So we think about them in those categories. And there's a lot to explore. And we'll give you a starting list, but there are many out there. And this is something that many personal finance channels talk about a lot. And you'll see articles in the money sections of the broadsheets about this, which might give you ideas you want to try out. But to give you a starting point, which, as I say, we'll send out on a document after this as alongside when we publish the video. There's quite a few to try out and explore in more detail. I won't go through them all now. But as I say, don't just rely on our list. Do your own research. Actually, the AI tools available are pretty good at giving suggestions. So you can use those as well. If you describe your scenario and ask for suggestions, they may give you some things you can try out. But do your own research. It's definitely worthwhile. So moving into the case study, we're going to look at a different case from the one we used in the previous two videos. We've got a slightly wealthier couple with slightly higher income, and this is really to try and explore a wider variety of optimization techniques. So it's Jerry and Margot. They're approaching retirement. They have a home worth £1 million, 1.2 million in financial assets, mostly pensions. And as you can see, Jerry has the vast majority of that in his pension. They're still working, and Jerry's on 125,000 a year, Margot on 40,000, and they're spending 85,000 a year. So you can see that they've got a fairly busy life, and there's some potential optimization opportunities there given the tax bands they're in. And their plans for retirement, keeping this simple but adding in something that we can plan around. They're planning to buy a camper van at the start of the retirement period when Jerry's 65, and go traveling for 3 years and sell the camper van at the end. And at the moment, because Jerry's pension is approaching the lump sum allowance limit, where he won't get any more tax-free cash if he carries on investing in it, allowing for growth and all the rest of it, they're thinking about their investment strategy and whether they should switch to ISA saving or can carry on investing in Jerry's pension. So we're going to go through the case study in 1 second. Before doing that, I just wanted to highlight the types of optimization techniques we'll be looking at for this particular scenario, so you can watch out for them during the demo. So we'll be looking at mainly investment withdrawals and contribution techniques around avoiding higher rate and additional rate tax on pension withdrawals, balancing withdrawals across pensions and other sources to optimize the tax, balancing the withdrawals between partners and the pension balances between partners to create a more tax-efficient withdrawal strategy, using pension tax-free cash in a strategic way to set up that scenario, and finding ways to smooth pension withdrawals. And finally, on the contribution side, trying to avoid earnings above 100k, which obviously attracts higher tax rates, and making contributions to partners' pension to again set up that opportunity for a more efficient withdrawal strategy. So those are the things we'll look at. When we go through the assessment, I just wanted to highlight a couple of features of the planner that we'll be using, just so you're aware of them. We'll be using the summary totals. For those people who are users of the planner already, you'll recognise this. So the summary totals at the top of the results screen, which give an overall view of the plan as a whole in current pounds, so in today's money, so you can make that comparable across different plans and assess the effective changes at a high level. We'll be looking at the income, expenses and tax chart to look at the tax in particular and the profile of that over the course of the plan. we'll see if we get time actually to look at the chart data tab, which is where we get a breakdown by individual of things like tax or assets, so you can get a sense of where there are imbalances between the partners and opportunities for efficiency. We'll look at the withdrawals and contributions chart to see how the withdrawal profile is working. We may look at the tax and IHT tabs if we get time, and we may look at the compare tab at the end to see the differences between the starting point and the final plan we come up with. Okay, so let's have a look at the plan. So this is where we start. This is the unoptimized plan, and I'll just close down some of this text to give a better view. What we can see here is the retirement period, which has a big peak in the middle of it, a lot in it here. And if we look under the covers, that's tax on pension withdrawals. And what's happening there is the pensions are being withdrawn first, because that's the planner's default approach, to withdraw from pensions and preserve ISAs until the end of the plan. So if you look in the detail here, you'll see that, let's bring the detail up. You'll see that the pensions are being withdrawn here. I might just enlarge that a little bit so you can see it more easily. The pensions are being withdrawn in this period, so you can see, and we're starting to draw on ISAs, and in this period at the end, ISAs are being used to fund the retirement spending. So the bit above the yellow line is our core expenses, which have a peak back here when we buy a camper van. And the bit above the line is largely the tax. So where there's a big gap between the yellow line and the top of the bar, we're paying more tax. So I suppose there's a question for us about how we mitigate this period here and the amount of tax we're paying. If we look at the income expenses and tax chart, we will see that in this period, we're starting to pay additional rate tax. So there's £11,000 of additional rate tax being paid on what turns out to be Jerry's pension withdrawals. He has the biggest pension. That's where much of the money's coming out. But at that point in the plan, Margot's pensions run out, and so all the money's coming out of Jerry's pension. Back here, earlier in retirement, we're managing to withdraw a bit more tax efficiently, whilst Margot still has some pension funds left. So I suppose that there's a bit here in this period where we want to see if we can mitigate the additional rate tax. And at the start, back here, we're also seeing some additional rate tax. This is because Jerry's over the 100k threshold, earning 125,000 at the start of the plan, and with increases in that, and the fix to some of the tax thresholds that we've seen continuing for another few years, a lot more of that is being drawn into the additional rate tax, and above 100k, the 60% tax band. So there's a mitigation opportunity there. And it's worth reflecting also that we've got this imbalance between Margot and Jerry in their pension assets, which may create an opportunity. So there's those three things it's worth us potentially taking a look at. So to try and do that, let's
Richard, we just had a comment in the chat. Could you just spend an extra minute just covering the sort of full scope of this particular chart, please? I know we're focusing on the tax elements, but
sure. So this is, yeah, absolutely. So this, just to summarize that, this is the income expenses and tax chart. So this chart allows you to see all of the incomes you've got, whether those are investment incomes or salary incomes, all the expenses, including both core expenses. So you'll see those in yellow, and in the grey at the bottom, you've got the tax. So above the line is incomes. Dark green is guaranteed incomes, which is essentially state pension. There's some investment returns, and there's some capital growth on the main home. And below the line, you've got expenses, and you've got tax. So hopefully that answers the question. Back here, actually, there's one other thing. So there's some unplanned expenses and some mortgage interest as well. So income, expenses and tax is the scope of the chart. Hopefully that answers the question. Okay, so let's move on, and we're going to edit the plan and see if we can try and deal with some of those gaps. And the first thing we're going to do, and most of the changes we'll make are in the savings and investment section, which is where a lot of the optimization work will go on. So the first thing we're going to do is look at our withdrawal strategy and see if we can change that to reduce that peak of tax in the middle of the plan. So as you can see in this withdrawal section, we've got a withdrawal profile, which is preserve ISAs, which essentially is the thing that's driving us to withdraw more pensions earlier in the plan and leave our ISAs to the end, and effectively creating that peak. So a simple thing we could do is change that. And what I've done is set up some plans which have got changes in them so we don't have to make them all as we go along. So the first change we're going to make is to add a change to this profile, which is to try and avoid tax on pensions above higher rate. And by above higher rate, we mean 100k and above, where we're starting to pay tax in the 60k band, and then 45% additional rate tax above about 125k. So we're going to try and avoid tax on pensions in that band by limiting our pension withdrawals to 100k. And then also within the higher rate band, say below that, we're going to mix ISA and pension withdrawals so that we further reduce our pension withdrawals and pay a bit less in higher rate tax. So this is one of the automated investment strategies that the planner provides, and we picked that one as the one which seems to be most relevant for Jerry and Margot. Given the size of Jerry's pension, he's probably going to be paying some higher rate tax. It's going to be impossible to avoid all of that. So this is a strategy that seems like the right one to start with. So let's see the effect of that. So here's the change, and we can see that what we've done is effectively move that peak of tax towards the back end of the plan. So during the middle of the retirement period now, we're seeing less tax. The ISA is being used to reduce the amount of pension withdrawals we need to, so we're not paying additional rate tax. But what we find is that essentially we've only got pension assets at the back end of the plan. So if I look in here and look at the detail, we can see that we've essentially run out of our ISAs and all the money's coming out of the remaining pensions. And it's also going through just one person's tax capacities and tax allowance, because this is when Margot's by herself at the end of the plan and she's only got her own tax allowance and can't benefit from Jerry's anymore. So we've effectively got a peak that's moved to the back of the plan. So if in the as part of the optimization process we can find ways to mitigate that, maybe by retaining more in ISAs to the back end, so Margot's got another source of income that doesn't rely on pension withdrawals, we can help to reduce that. So it's worth noting that. One thing I'll point out now is the KPIs. So I mentioned these before, and one of the things to look at that we're going to use as we go through this optimization is the legacy value here. So for this plan, it's quite a useful guide to see how the legacy value changes. So how much money they have at the end of the plan and whether that's going up or down as we make changes. So if we go back to the first plan, before we did anything, we had a legacy value of 1.385 million, and that was made up of other investments. And that other investments is essentially the house, post-sale, and any remaining ISAs. We don't have any pensions left. So this is where we started. And now we have a higher legacy value. So from 1385 it's got to 1433, but some of that's in pensions. So we've got the 1316, which is essentially the value of the house, which haven't changed from the previous one. The rest is in pensions. As we mentioned earlier, the key differences in pensions are they're taxable for the beneficiaries, so we're going to have to knock some off to allow for the income tax that any beneficiary will have to pay on that, and they're also less flexible. So from a gifting perspective, if you want to later use this as part of your IHT mitigation strategy, pensions aren't as useful as ISAs. So we have to take those things into account. And I should say these numbers are current pounds and post-inheritance tax. So it's worth noting that, but it still means they're effectively comparable across the plans. So if you net off an allowance for higher rate, basic rate, or no tax for the beneficiaries, depending on your beneficiary, that number is effectively higher than where we started at 1385. So we've made an improvement, arguably, although we've got some of the assets left in pensions, which are less flexible. But it's worth noting that we'll carry on as we go through the optimisation. So we've seen that we've pushed the assets to the back of the tax to the back of the plan. Can't really do anything about that right now. So let's just move on to try and do the second mitigation that we identified earlier and reduce the additional rate tax before retirement and see what difference that makes. And we'll come back to the new peak of tax we've got at the end of the plan as a next step after that. So actually, let's edit this one to see where we start. And what we're going to do now is try and mitigate that peak of additional rate tax before retirement. So we'll look at the contribution strategy. At the moment, we've got this automated strategy, which is ISA first. So essentially, any surplus is being pushed into an ISA and using up both Jerry and Margot's ISA limits of 20,000 each to with the surplus. Any excess might go into pensions, but the bulk of it's going into ISAs. So to try and mitigate the additional rate tax, we're going to do that by contribution to Jerry's pension. Now, Jerry's, if he was an employee, he might have the option of a salary sacrifice scheme, or we could enter that into the earnings and pension section, but he's self-employed, so we're going to put it in as a SIP contribution down here. So as you can see, we've added this thing called a custom contribution to Jerry's pension during the period before he retires at 20,000 a year, which once you net it up by 20% using the tax relief, that would, at the start of the plan, bring his income down to 100,000. We've got some inflation and increase in here to try and mitigate as much of the amount over 100,000 as possible. But what I found by doing this optimization is I don't have quite enough money to do that. It's not quite enough surplus. So I've just put in as much as I possibly can. As Jerry's salary increases and their spending increases, the amount they've got as surplus isn't enough after a couple of years to cover the full amount that Jerry earns over 100k. So we're doing what we can, but it's not going to be perfect for them. So let's run that and see what the effect is. So let's start off by looking at legacy value. So that's gone up again. So previously that was 1433, and now we've got up to 1449. There's a bit of an increase, and doing the tax calculation on the DC pensions shows that overall it's better financially, albeit the pensions are less flexible, as we said. And the other thing to note is our profile's changed here. So we've got a longer period at which we're paying more tax at the back end of the plan. And the reason for that is there's more money in Jerry's pension, there's less money in ISAs because the money was going into ISAs before, and it's now going into Jerry's pension. So there's a longer period over which we're reliant solely on Jerry's pension to fund the retirement spending. So in one way to look at this is that this actually creates more of an opportunity for further optimization, because actually our financial outcomes improved a bit and created more of an opportunity. So what we really need to do now is find ways to avoid it being all Jerry's pension that's funding the back end of retirement. And one thing we did note when we went at the start was there may be an opportunity around Margot's pension, because she doesn't really have much in a pension. She started the plan with 200,000. There's the lump sum allowance cuts in at just over $1 million. So until you've saved $1 million, including growth, you've got the opportunity for tax-free cash on withdrawals. So that creates the opportunity. One thing we could do, given that Jerry's age at the start of the plan, which is 58, he's already reached minimum pension age. He could take his tax-free lump sums and start paying that into Margot's pension. As long as he just takes the tax-free cash lump sums and doesn't access the taxable portion, the drawdown fund, at all until he retires, then he'll retain the ability to carry on contributing to his pension, which obviously he wants to do what we did in the previous step around mitigating his 60% tax before retirement. So if he just takes the tax-free cash and pays that into Margot's pension, that could be a useful strategy. So let's see how that might work. So where we need to go to now is pension withdrawals. So I've added this in. So previously we just had this automated strategy to allow automatic withdrawals throughout the course of the plan. I've added this in, which is a pension crystallization every year during the first part of the plan before retirement. So every year we're going to crystallize £120,000, which the tax-free proportion of which 25% is £30,000, which is roughly Margot's pension contribution capacity. So in round numbers. So I've gone for £30,000, since once you gross that up with tax relief, as it goes into Margot's pension, she'll have 37,500 of pension contributions, which is roughly her 40,000 salary at the start of the plan. So it sort of takes up the bulk of her capacity to save into a pension. So added that as a custom contribution, and I've also put this flag on here, which defers automatic withdrawals. So this is the thing which will prevent the planner automatically withdrawing from Jerry's drawdown fund until a certain date, and this is his retirement date. So he'll retain his ability to carry on contributing to his pension at the same level and won't be restricted by the so-called money purchase annual allowance, or MPAA, until he retires, when he won't be contributing anymore. So looking at the contribution tab now, we're going to add in a contribution for Margot, and I've added this in. So DC pension contributions for Margot during her period of employment, £30,000 net, grossed up after tax relief, that will be 37,500. And so let's see what the effect of those two changes is. Okay, so we can see there's been a reasonably significant change to the chart. We can see some reinvestment happening here. We can also see a return to where we were before, effectively. So this period here that we had where we were paying more tax when the money was just in Jerry's pension, we've sort of flattened that out. So obviously the effect of having more money in Margot's pension and less money in Jerry's, because we took out the tax-free cash earlier, so it didn't grow inside Jerry's pension for as long, plus having the benefit of the 25% tax-free cash in Margot's pension to give us more funds, has created this overall flattening of the profile. We've still got this peak at the back end when after Jerry's death, where Margot's just got her own tax capacity. So it would be great to have more ISAs to help us flatten that out, which will maybe take another step on. But if we look at the legacy value, we've gone up to 1564, and more of that's in pensions. But overall, if you take off the right amount of tax, higher rate or basic rate, you've got an increase in the legacy value from the previous step, whereas 1449. So we've got another optimization opportunity. So the question now is, how do we retain more ISAs to the back end of the plan to help Margot reduce her tax bill after Jerry's gone? So one thing we could potentially do is draw more out of Jerry's pension earlier in the plan and accept the fact that we're going to pay a bit more higher rate tax in that period, but allow us to redeploy those assets into an ISA. I mean, it might not work, but let's see what effect it has, because overall the balance might might improve as a result of doing that. So we're going to edit the plan, go to savings and investments, and we'd make this change in other withdrawals. So this is the automated profile we had previously, and here's one I prepared earlier. So what I've done, and this took a little while by trial and error, to work out the right amount to withdraw from Jerry's pension, but the best results seem to be forcing the planner to take out about £50,000 of withdrawals, and the remainder being following this automated profile, so that more of the money comes out of Jerry's pension during the retirement period. And another setting that I found useful at the same time was this reinvestment setting, which forces the planner to draw out from pensions up to your full basic rate band to reinvest. So what that will do is make sure that all of Margot's basic rate band is used to withdraw from a pension until the Margot's pension is exhausted. And the combination of those two things helped us get more money into ISAs and balance things out a bit better. So we can look at the results of that. And we can see from the shape of the chart, there's been a fairly significant change. So at the end of the plan, we've flattened that out. So, and you'll see that in this period, if I scroll down, that I'll look at the detail, we're withdrawing from ISAs and pensions, which reduces our tax bill. And we still have ISAs at the end of the plan. And earlier in the plan, we are withdrawing more from Jerry's pension, which means we're paying more higher rate tax. But let's see what the balance is. So we can see the overall legacy value's gone down. So it was previously 1564. It's now 1493, but there's nothing in pensions. We've exhausted our pensions. And in fact, that was the thing I was trying to do by choosing the amount of funds to withdraw from Jerry's pension during retirement, to try to get to the point at the end of the plan where we had nothing left in pensions and it was all left in ISAs, which actually does a couple of things. One is it makes it comparable to the starting plan where the funds were all in ISAs. We've got the equivalent flexibility, but it also means that at the end of the plan, we're in sort of a better position to later plan a gifting strategy, because money in ISAs is easier to gift than money in pensions. So that was the basic thinking. Although there's some question which we could come to, which you could come to later, a later stage in the planning process, perhaps post-retirement, to try and work out what the right strategy is in terms of the amount to have in ISAs, the amount to have in pensions, given a better understanding of what your legacy is likely to be and who your beneficiaries are likely to be and what the tax situation is likely to be, all of which have a bearing on what assets you should hold at the end of the plan. ISAs gives us the most flexibility, so we're going to go in with that. So let's compare between where we are now, the final version of the plan, and where we started. So I'm going to shrink this back down a little bit so we can see both charts. So we're using the compare feature now. This is where we started and this is where we ended up. So, and you can see the legacy values moved, and this is after IHT, between 1385 and 1493. So we've gained after IHT about 110k-ish of improvement overall, with all those assets at the end of the plan still in ISAs. And we'll recap on the main changes we did to get there in a second. But before we do that, let's just take a look at another useful comparison, is the assets and debts chart, the net worth chart, effectively, to see what difference we managed to make. I'm just going to close down those plan totals and view this in full screen. And so you can see in the top plan, which is the final plan, we've got more liquid assets at the end of the plan. The chart's dominated by the value of the house, and obviously at some point you might decide Jerry and Margot might decide there's a downsizing strategy or something like that to release some of the capital, which would be another discussion. But for now, the benefit they've gained is before actually. What we can do is compare this in current pounds to make it easier to understand. But we've got an increase of, closing on about £460,000 in future pounds between the starting plan and the ending plan in the ISA balance at the end. So if we just change that to current pounds so it's a bit more meaningful, we'll see that the difference is £272,000 of ISAs or investments at the end of the plan in the new version versus 45,000 where we started. So about 30,000 of improvement before IHT. So let's just recap on where we've got to and how we got there. So we started with an unoptimized plan. We went through several steps, the first of which was to change the retirement withdrawal strategy to using ISAs to limit tax on pension withdrawals. Then we used pension contributions to avoid Jerry paying 60% tax before retirement. Then we used Jerry's tax-free cash to contribute to Margot's pension and give a better balance and more income sources over the course of the retirement period. And then finally, we used increases in Jerry's pension withdrawals, so Margot's pension and the ISAs lasted longer and gave a better balance in the withdrawals at the end of the plan, and also a more flexible ISA balance rather than the pension balance for inheritance tax planning, with overall an increase in assets before inheritance tax at the end of the plan in today's money of about £230,000. So hopefully that was a useful illustration. I know there's a lot to go through, and some of it was quite technical. We're going to publish this recording so you can go back through it if you want to and get some hints and tips. But let's move on to Q&A and see if there are any questions that have come out that we can answer on the call.
Richard, we've had quite a few questions come up, but I've been able to tackle most of them on the fly. I think it might be worth just sort of reviewing your 4 steps again and just comparing the relative benefit of each one, and perhaps as you were kind of going through the example, what did you actually learn? Because I think this is the point, isn't it? Is that this is a bit of a journey to understand how to optimize your plan, and what sort of things surprised you as you were going through the process for this case study?
Yeah, it's a good question, James. And what I would say is it is absolutely a journey, and it's one you can't fully predict from the start to the end. And there are definitely more tests we could do and trials we could do on this to see if there are any other improvements that we could make. What I found was that each step you couldn't look at in isolation. It played off to the others, and so you ended up following a journey and then maybe backtracking a step because the effect wasn't as you expected or didn't give you as much benefit as you expected, and you sort of had to look under the covers. And we didn't actually use all of the features of the planner to look under the covers. So I spent a fair amount of time looking at the withdrawals and contributions chart and table to see how much was being taken from Jerry's pension versus Margot's pension, and the assets and debts table to see how much Jerry had left versus Margot had left in their various investments, to make decisions around what to do next. So it was you do learn a lot about your plan by going through the process, and you do use many of the features of the planner, some of which I didn't show you today, to make those decisions. I did have to say go down a couple of blind alleys. So, for example, I thought there was going to be more impact of using a lump sum to buy the camper van at the start of the plan, but it didn't really make as much difference as using the money to invest in Margot's pension. So that's where I used the money to help mitigate the problem we had with just having one main income source during retirement. So it's a I won't say circuitous, but sort of a winding path that you follow as you do this, and you try things, and you see what works, and you see what doesn't work, and you try applying the same idea a bit later in the journey, and it has a different effect. So you sort of got to step back after regularly to look at top down what's happening, and then and sort of get out of the weeds and try some big ideas. So I think having those big ideas to hand, which is why sort of identifying the main techniques up front that you think will apply to your plan, is a useful thing to do, because it forces you back to trying those things out and seeing what their effect is and working out which ones are applicable, and then sort of combining the ones which work the best and work together the best to give you the best result you can find.
We've got a couple more questions, Richard. Are the steps taken to avoid the 60% income tax applicable if you're worried about the sort of the 40%, sort of the end of the basic rate band, and you're trying to avoid 40% income tax? Is the same strategy relevant?
Well, similar strategies, I would say. So I suppose the good thing about the being able to use pension contributions is you can get yourself out of higher rate bands. So if your earnings are in sort of around 70 or 80,000 or something like that, you've got 10 or 20,000 which is in the higher rate band, or even 5,000 in the higher rate band, and you can afford to use pension contributions to take yourself back into the basic rate band during your working life. And then, depending on your expenses, you might find that you could be a basic rate taxpayer in retirement, because maybe your expenses are going to be a bit less or something like that, because you found ways of living more efficiently. And so the benefit of having contributing with 40% tax relief plus 25% tax-free cash, compared to the cost of the 20% basic rate tax in retirement is generally enough to make that worthwhile. But it is very contextual to individual situations. So, and then again, that point about the balance of assets between the partners, and whether the bigger opportunity is your partner's pension. So there's a variety of considerations, but in general, it is applicable. Yes, something similar anyway.
So Les has asked about, can you see the total tax spend across the whole plan in the planner?
Yes, that's a good question. So if we go back to the planner, I mentioned this KPI section of the SOT. We've been looking at a lot of the legacy value. We've not used the other aspects. If you go into plan value, and there are effectively three views: plan value, plan income, and plan expenses. The plan expenses view has three components, one of which is taxes. So you can see here the difference in tax you're paying, or you can see the tax you're paying. And if we look at the starter plan, this will be interesting, because we've got a lot more income than the final plan. We might find that the final plan has more tax, even though it's got a better outcome. So yeah, so the final one has more legacy tax, which you'd expect, because there are more assets at the end, so you've got more legacy tax. Slightly higher lifetime income tax, because I guess we've managed to grow our wealth a bit more by putting more into pensions, which grow more, and so you end up with a bit more tax on withdrawals, but not dissimilar in terms of the income tax between those two scenarios. And those, I should also say, those are in current pounds. So for comparability's sake, that's the total tax across the plan in current pounds.
Do you have any suggestions about where to go for help with sort of researching optimizations and suggested strategies, Richard?
Well, I mean, there's a lot of resources available these days around this. There are quite a lot of channels which publish on this stuff. Obviously, we have an emerging channel which talks around how you use the planner to do this stuff. But there's a lot of content out there. We partner with a channel called Pension Craft, so that's a good one. They focus on how to manage your portfolio for risk and return, but also for tax. They have some good material on this. There's also a blog channel which we refer to a lot called Monevator, which is not a YouTube channel. It's a website called monevator.com. We'll put the link in the channel, which is a UK channel and has a lot of useful content. Martin Lewis has started focusing on investment. He can come up with tips, and I anticipate it will come up with more over time. There's the money sections of the broadsheets, which often have useful content. There's a lot out there. I'd encourage you to do your own research and you use AI tools to put in your situation, see what comes back. I use Perplexity, which gives you the sources, and you can look at you can use it to find useful stuff relevant to your situation, and it will come back with a source, so you can look at the underlying source rather than rely on AI hallucinations to get it wrong. So there's a variety of sources. Actually, I should add to that. If you've got questions you want answered, there's quite a few forums out there. I'd obviously suggest ours. So we have a Reddit group and we have a Facebook group, both of which are focused around users of the planner and ideas for tax optimization. But there are others out there as well. UK Personal Finance on Reddit is a big one for UK people. So hunt down things that cover your situation.
Great. I think we've reached the end of the list of questions. Apologies, anyone, if I've missed anything. Do feel free to chat us after the session ends. Thanks very much for joining us today, and we hope you've taken some useful ideas from this session that you can apply to your own plans. We'd love to hear your feedback on today's webinar, on topics you'd like to see covered in future webinars as well. So pop your thoughts in the chat before you leave, contact us through the planner, or post to our Facebook or Reddit community groups, which I will also just paste into the chat now as we close the call. Many thanks for joining, and we look forward to seeing you again in the near future. And with that, I wish you a cooler rest of the day.